From the morning reading, stocks pause, test breakout as Spider, Diamonds, Qs, and IWM form horizontal bull flag once again. 4 of 9 sectors moved higher on Wednesday. XLP, XLY, and XLB were the strongest sector, while XLE was the weakest sector. Oil futures fell $1.26 to close at 41.49. Breadth weakened compared to the prior session as decliners led 1644 to 1309 on the New York Stock Exchange and led 1583 to 1583 on the NASDAQ. So that seems to be even there. Also in the morning reading, on our S&P 500 snapshot, it was a modest loss on an energy drag. Major markets around the globe posted modest declines with the big drop in oil as the underlying drag. The S&P 500 hit its 0.08% intraday high shortly after the open and then sold off in waves to its negative 0.45% mid-afternoon low. Some volatility in the final hour trimmed the loss to negative 0.29%. How substantial was the oil drag on the energy component? West Texas Intermediate crude ended the day at minus 2.48%. The demand for treasuries increased again. The closing yield on the 10-year note fell 5 basis points to 1.50%. Also in the morning reading, over the past month, stocks have enjoyed an exceptionally calm climb to new highs. The S&P 500 hasn't had a 1% daily change in over a month, one of the longest streaks since the bull market began in 2009. While that could be considered evidence of too much complacency among investors, previous climbs to new highs with no 1% moves did not lead to substantially worse or better returns than others. Wall Street wasn't buying the rally though, at least that's the case according to strategists, who are recommending a nearly 20-year low exposure to the stock market. But this is a misleading indicator, with the survey being grossly skewed by a single individual. Wednesday's minor sell-off triggered some put buying. On the ICE exchange, option traders bought to open more protective put options than speculative call options for the first time in a month. Protracted put buying is a contrary indicator, but single-day readings are not. Since 2006, when the ICE equity call put ratio is below 100, the S&P 500 rallied over the next 2 days only 43% of the time and averaged a return of negative 0.4%. The indicator would be a better gauge of contrary opinion if and when it averages less than 100 over at least a 5-day period. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:27 a.m. Mountain Time, and I'm recording this in preparation for the market day of August the 11th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. At the time of this cut, we were positive across all 4 of the U.S. broad-based indices, though modestly. The S&P futures are up just above scratch. The Russell futures are up about 1/3%. The NASDAQ and the Dow futures are up about 1/4%. Crude oil continues to be the source of volatility remaining in the market. It's down about 2/3%. Euro's down just below scratch. Bonds down about 1/4%. Gold just below scratch. In overseas action, you got China down about 0.5%, but Hong Kong going the other way, up almost 0.4%. Japan down just below scratch. Germany is positive, almost 0.5%, but the United Kingdom is negative, about 1/3%. So very mixed action in the overseas. So if you are one of the followers of the Seven Sisters method, you're in a mess. And Thursday's macroeconomic report action for the United States, you had the weekly unemployment claims, you have import prices, nat gas storage, and a 30-year bond auction. And looking forward to tomorrow, you have a number of red flag reports. core retail sales, PPI, retail sales, core PPI, that related cluster. In terms of current volatility conditions, we continue to have exceptionally low volatility. Short-term VIX is only a 10.68. Skew dropped a little bit. It's now above 130. So still a bit of a warning. IV percentile still continue to be extremely low, with the S&P at a 2, the Russell at a 3, the NASDAQ and the Dow also at a 2. No standard deviation moves were put in on a close-to-close basis yesterday on any of the 4 broad market indices. We'll go ahead and bounce over to the charts. And this is the S&P futures, and you see we continue to kind of go into this, what one of the morning authors referred to as a horizontal flag. And this is pretty much what happened in this about 13-day session here. And you finally kind of broke out and had a confirmation of that breakout. But then once you had that breakout on this last Friday, we've just gone sideways ever since in very, very narrow range and low volume days. So not much to be made of this price action yesterday or today. You had a little bit of a pullback, and as the morning reading made reference to, mostly driven by the energy sector, with that West Texas crude having quite a significant drop. We've recovered a bit today in the S&P futures, but again, very, very small ranges, not much to get excited about here. Dow's done the same thing. NASDAQ, the same thing, still sideways. And Russell recovered some of what it lost yesterday, but basically is in a sideways. This is a more traditional kind of bull flag pattern over here. Let's take a look at crude oil, and you see crude oil had a big pullback yesterday, and we had the question going into yesterday morning as to whether we're going to see a higher high or a lower high, as it were. And, you know, are we making a bear flag or are we making a bull flag? Did we have a bottom down there around that 39 area? And right now it looks like we had a potentially a bear flag. So we'll have to see if we get a lower low or if we get a higher low. So that's the trick to it. You see, you got this swing low right here. And does this pullback now form a higher low from here, or does it break this and form a lower low? That will tell us whether we're in a continuation pattern on this action or whether we're reversed and we're starting to make some move back up. Now, to move up, we're going to have to fight through a lot of overhead resistance. Remember, we're below the cloud. This is bearish. And, you know, really almost everything here tells us that the expectation for the intermediate term should be bearish. So this continues to be the primary source of volatility in the market at this point. We have been seeing some pretty big moves in crude oil, while at the same time the equity market has really been very, very calm and complacent. Let's take a look at gold. Gold continues to play inside its triangle, and we're waiting to see what kind of break we get. The expectation is that we'll get a bullish break. There are trading opportunities here in gold, especially if you use GLD, the ETF. But the thing is that you're going to have to be making sure that you buy enough time and very, very patient. This is not an easy trade for novice traders. This is probably a more intermediate trade just because of how much you're going to get challenged. Just when you think it's going to break the bullish side, this will pull back hard and test you, and then eventually resolve to the bullish side. That seems to be the pattern that we've had all year. Really, in fact, if you go back to the beginning of the year, you had this whole thing started in the middle of the Christmas week, and it's been basically bullish ever since. But you see, like right here, just when you thought things were going hunky-dory, you get this big test that comes all the way down and just barely undercuts these swing lows, and you think, oh, this is broken, we're below the cloud. But then what does it do? It rips back up, sets up a new high, another flag, and then sideways consolidation, a lower high, and so now here we are with this triangle. So, we've had a couple of these kind of moves like this one here and this move here that are really testing the willpower of the gold traders. So just kind of be aware of that. I've been watching it myself. I've taken a couple, 3 trades along the way here, and I'm considering entering again, but I'm telling myself that I've got to do it in such a way that I'm going to be tolerant of big adverse moves. It's just part of the scene with gold. In terms of, let's go ahead and look at bonds. And you see bonds, pretty much a sideways consolidation action here. This is pretty sloppy though. But really everything, ever since you had this pullback here, it's been pretty much sideways. I mean, some of these candles are large, and this is not a very good kind of rectangle or triangle or anything really. It's a pretty sideways, sloppy consolidation, but it's still, frankly, in an intermediate term bullish. So you still, if you're going to make a mistake, I would suggest, if you think that bonds are going to just crater and fall down, that has not been the story of 2016, and it's still in an intermediate term bullish posture. Okay, let's see. Is there anything else we need to take a look at today? I think we're okay on the charts for the moment. Let's go ahead and bounce over to the daily report. And first of all, of course, our postures and market timing signals. In terms of our market trend intermediate term phase opinion, that's market phase 3, bull flag bill. That, of course, includes both traditional flags as well as these horizontal flags, which seem to be the story of late. And the market timing signals, we have 3, all mechanical in nature. The first one comes to us from IBD, and it's in confirmed uptrend. The second one, GMI index, 6 out of 6 with the buy signal in place since 7-1. The third one's the messy one, the stock charts decision point scoreboard. Gives us more information because it does look into different indices and does look at different intermediate, short-term and long-term time frames, which is very helpful, but it also tells us when things are perhaps a little noisier than we might be led to believe with the first 2 mechanical signals. And this is a reflection of this sideways action. Our short-term has several mixed signals, and our long-term also has several mixed signals. So kind of keep that in mind. If we're to actually pull up the charts on the intermediate term, you'd also see that they're not that far from going neutral either. So while the consensus here is clearly bullish, and we're going to expect to have bull flags, they may not go very far. And why I say that is because volatility is so low, and we're somewhat extended on a number of indicators that would lead you to believe that we're going to probably continue to ebb mostly to the bullish side, but we're not going to get very big moves. So until volatility comes back into the market, which may not happen until after Labor Day, we might have another 2-3 weeks of this small range activity. At some point, volatility will expand. We might get a test to the downside with a retracement before making the next significant leg up, or we may ebb up to a new high and then kind of retrace slightly back and forth with these low volatility moves. It's a very, very kind of small range kind of trading right now, unless new information comes in that gives us cause to make a larger move. And that doesn't seem to be on the table right now. That can always happen though, so we always have to be ready for it. In terms of position sizing opinions, right now both models are at 100%. In terms of intermediate term market postures, these are all very strongly bullish, and you see 95, 96, 91, 96. They're all above 90 now. Very, very significantly strong bull signals on the intermediate term market posture. These are all reinforced with the bullish sentiment line. So, you know, you definitely got to respect that. Strength of the trend is also strong bull. Hedge warning status currently at a 0+ normal with some cautionary aspects. No change in our strategy opinions. Pretty much been the same most of this week. VIX is borderline acceptable to initiate new positions for option income strategies. Keep that in mind. And that's because the VIX has been so low. And we may actually, let me think about this. We may actually have gone above a 12. Give me just a second. Nope, we're still below a 12. I think we closed at 11.85. And when we're below a 12, I consider this borderline acceptable to initiate new option income strategies for novice traders, because you're getting paid so little to be able to take on that risk. And oftentimes you're having to place your strikes so close to the price action to get any kind of money for your trade that when the volatility does expand, and it will at some point, it can really set you up for some struggles. So kind of just keep that in mind. This is not the ideal market conditions for option income strategies because of the low premiums that are currently in play. Cover calls and put selling, both of these are fine right now to initiate new positions for novice traders. No changes on those from the rest of this week. In terms of specific warnings, same 3 warnings we've been dealing with. 2 of these relatively low grade. The VIX daily squeeze is still present. Obviously, we're expecting volatility to expand, and we've got 2 different warnings that are telling us that at some point. Another thing I will mention, this is not yet in warning status, but these distribution days have been kind of building, and we're now at a count of 4 on both the S&P and the NASDAQ. When that goes to 5, that becomes a warning. So just kind of keep that in mind. This has been quietly kind of building, and you know, it's been one of these things where, yes, we continue to make these new highs, but we also continue to kind of challenge to the lower side with this distribution day count. So it's definitely been a pretty sloppy kind of bullish move. In terms of trend-based indicators, these are all fine, all strongly bullish. Nothing really to get worried about here. I will say on the risk aversion indicators, I still have these all as risk on. Some of these are so tightly wrapped sideways, I could call this anything. So really what you need to say is they're neutral, not really strongly bullish or strongly bearish. They're really better to be said as neutral because the lines are just flat out sideways and they're just wrapped around each other. In terms of sentiment, the intermediate term is still a bit elevated, so keep that in mind. And indeed, we see on the Fear and Greed Index, we're still in that upper quartile, though just barely at a 75. In terms of sector-specific information, we continue to see this deterioration of late in the short to intermediate term, and that is now spilled into the long term for several of the sectors: transportation, telecom, energy, and utilities, all looking relatively weak. Also, consumer discretionary and retail in the short to intermediate term showing some significant weakness. The thing I would primarily focus on is energy continues to be the source of volatility, being driven by that crude oil price and that impact on the energy-related sector. It's really been, if you're a trader, if you're an active trader, it's been the source of places to play of late, but it's been quite a wild ride both directions. In terms of are we moving risk on or risk off, right now, you know, we see the stubs, we see consumer staples, it's up. We see telecom, it's neutral to down. We see utilities neutral to down. And then, of course, bonds have been in a sideways pattern. So the stubs group, or the risk off kind of group, are not doing terribly well, but I can't say that they're horrible either, but they definitely have given up a lot of their strength that they had earlier. Whereas when we look at the risk on, well, we look at things like technology, well, they're all up, materials all up, industrials and financials all up. So for the most part, the risk on group is performing slightly better than the risk off group, but it's hard to make too much of that because there's not a lot of separation between their performances of late. And you can see that if you dive into the percent change. Yesterday, of course, it was mostly about the risk off. The utilities, consumer staples, telecom, they were the better performers yesterday, but yet modestly. Nothing really to get excited about. And whereas the high beta risk on sectors were the ones that were giving it up a little bit, but again, for the most part, modestly. Financials and energy definitely gave up a bit more. So kind of keep all that in mind. Not a strong, clear sign of risk on or risk off at this point. So we're about 20 minutes. Let's go ahead and wrap this thing up. And we'll hit the disclaimers. Always got to do the disclaimers. And hit the pause button if you need more time to review the disclaimers. Also note the hyperlink down here at the bottom for the full set of disclosures. We'll see you back here for tomorrow's market preview from Falcon Global. In the meantime, manage that risk. And if you do that well, you'll find that everything else will fall in line and your performance will be much more consistent. Good trading.